Good afternoon and welcome to HYCM's online trading workshop with myself, Giles Cochran, the Chief Currency Analyst here at HYCM. Okay, it's great to have you here, everyone. Just going to say hello as people are coming in. Hi, Clement. Hi, Hashik, Rosemary, Sammy, Van. Good to have you. First of all, I have to make an apology. There was an error yesterday, and although it was a bank holiday here in the UK and I wasn't to be doing the FX week ahead, some of that message didn't get through to folks. So my apologies to you if you were expecting the FX week ahead at 12:30 yesterday and missed it. So apologies for that. And hopefully in future we're going to set up a system so that people get notified when I'm away, so you don't turn up for no reason. So my apologies first of all if that happened to anyone who came. Thanks, Ashik. Yeah, hi Sammy, good to have you on board. I take it you're all hearing me okay and I'm coming over loud and clear. Yeah, that's great. Just before we start, as I have to go through each week, don't forget, and it is important, that the workshop here is not a signal service with the FX week ahead and the workshop. And what this is not about providing trading signals for you guys to trade. Although I do from time to time discuss positions I'm in. I also talk about trades I've taken. We also look at entries, stops, and exits. All of this is from an educational perspective, and as some of you guys know who've been following me along recently and for a while, this is all about understanding what is the story that's going on in the markets, so that when you tune into that story you can make your own decisions, you can recognize when the story changes, and you can find yourself trading the best currency pairs. And all this is a process and it takes time to learn. So the whole point of these workshops and webinars is for you guys education. So you start looking as it were over my shoulder, and then by looking over my shoulder you start to be able to make your own decisions and see the reasoning and the rationale for it, and that will make sense to you over time, and then you start to be able to do that yourself. So as we're looking ahead, don't forget that there is a handout that is attached on the GoToWebinar control panel. If you look at your GoToWebinar control panel, there's a little section called handouts, and if you just double click on that handout session, you will have a handout like this that will come up. That is the handout that we will be referring to during the webinar, so make sure you've got that printed out. And as I said, this isn't just a handout that you just sort of open and ignore. The idea is that you use this handout and you print it out and you use it as a guide for your trading session by session, so you can try to find yourself in the right part of the market. And as I said, that's a deliberately planned workout session handout from me for you guys. The special topic we're looking at today is how to trade using calendar expectations. Each time there's a calendar, you have the expectations of various data releases. Now, sometimes you can have a good sense of where a currency is going to go just on those calendar expectations. So just on what's expected to come out for a currency. So I'm going to be showing you, a way of how to use that so you can find trades early in the week. Okay, so ideally from a Monday, you can find trades that are likely to be moving in a certain direction up until a certain news release. And I'll explain more in detail when we actually get to the section, but it's a really good and helpful tool to have in your trading arsenal. And each week it's worth just looking ahead at what's coming up for the following week, and I'll show you how to go about making those kind of decisions and what you need to look for. We'll cover it in more detail as we get towards the end of the webinar. Handout for session, we've already covered that. Don't forget the email suggestions for topics. You can email me here at giles.cochran@hycm.com. Got any questions, anything you want covered, just email me there. Particularly if you've got a question about the market you don't understand, maybe like a special topic you would like covered, just email me there. And of course, don't forget that as we're going through the webinar, you can just type your questions into the GoToWebinar control panel. So for example, if you wanted to tell me, what currency pairs are you looking at? What potential trades are you looking at? Would you like my suggestion on them? Well, just pop it in the answer question panel, and we can talk about it and discuss it together. Okay. Now, as we're going into the handout, one little sort of change that I've made is just to really underscore something. And what we're underscoring is the whole idea of trading is we want to find a bias for a currency pair. And the best way of finding a bias for a currency pair is we want to pair up strong currencies with weak currencies. I've said it before and I'll say it again, but it's a bit like a fight. If you had to bet on two people fighting, you'd want to bet on the strongest person fighting the weakest person, okay? Because that's the most likelihood you've got of making a accurate prediction, right? We're doing something very, very similar in the financial markets. What we're trying to find a bias where there's a strong currency against a weak currency. So each session, we're looking at reasons where a currency might be strong, and then we're looking at reasons why a currency might be weak. And then we're trying to pair those currencies together so that we then have a bias for a currency pair. So we know, if there's a strong and a weak currency, then we know that the strong currency is likely to find bids. It's likely to be bought as it retraces. Likewise, we know the weak currency is likely to be sold. So if we pair them together, then we should have a nice straightforward bias for a currency pair. Now, as we get going, turn to your handout, and we start this in order where we run through the handout. If this is your first time for today, the way we run through it is we go from looking back, looking forward, looking at the charts, looking at your risk, and then looking at the outcome of your trade. These are the 5 major categories that we look at and that you want to be looking at every single trading event. So let's start by looking back. So we see the first thing we want to do, we want to identify recent sentiment by reading up on the last 2 sessions of market activity, and we want to summarize that sentiment in a sentence or 2. That's what we want to try to do. Let's try to summarize what's going on. So coming to the desk, now we're going to go through some things to help cement this into our mind, particularly some of you regular guys. Now, so we come to the market, the Asian session. The Asian markets were quite mixed following yesterday's general relief rally. And the first thing to note is that risk is very fragile at the moment, okay? We are in the scenario where we had a big risk off sentiment on Friday, then we had risk on Monday, and now we're in a very fragile risk mode. And obviously with the clues in the picture, with the US and China in the middle of trade wars, the market is fluctuating quickly from risk off to risk on based on what's happening between US and China. So we need to be aware that any risk sentiment is very, very fragile. So we're looking at potentially quick short-term moves, okay? So we're looking at particularly short, quick moves. So that's the first thing to notice. That's what we've been seeing. Now, if you look at the Asian equity markets, when I came to my desk this morning, the Nikkei was up 0.96%, so that's pretty good. Nikkei futures, they were up 0.2%, they're now up 0.39%. The Hang Seng was down 0.6%. Shanghai Composite plus 1.35%, S&P Australia 200 up 0.48%. So we're in a kind of a fragile mixed equity markets. Although we've got the Nikkei's up, the Shanghai was up, the Hang Seng was flat, Nikkei futures not a great increase. So we're kind of in a 50-50 fragile, sensitive time when we could have risk move one way or the other. Don't forget US and China. It's a huge deal between the US and China at the moment with the trade war, with both of them contributing such a lot of the world's GDP. You can see why it's just such a focus for financial markets. So this, again, just underscores with China and the US taking up about 40% of the world's GDP as a whole, they contribute that much. It means that any issue between the two of them is going to keep rippling over to world markets. So it's firmly in place. And the great concern now is if China and US kind of agree some kind of trade deal, then everything's going to carry on. Okay, we've had low interest rates. A number of central banks have been reducing their interest rates. That's very good for company borrowing, company investing. So if US and China kind of agree to, agree their differences and keep plowing on forward, then that's good for the whole world. If China and US, if it escalates worse, and if China and US end up, not trading with each other and then start telling their partners and their allies not to trade with the opposition, then in that kind of situation, we're looking at some really strong ripples, and we'll look at much slower global growth. It could be a really big slowdown in global growth. So just watch out for that. That's why we're seeing bond markets, getting so many bids into the bond markets, because people are trying to find somewhere safe to put their money, and they're generally being worried. This is more general comment rather than a specific comment right now. So just to be aware of that situation going on. Okay, so again, let's do this to test some of you guys. Some of you regular guys can help out here as well if no one's able to answer the question. The question is, why do FX traders care about the equity markets? Why does it matter that I'm looking at the equity markets? Why would I do that? Is it just to say, oh, the Nikkei is up or the Nikkei is down? What is the reason that FX traders care about the equity markets? What do we use it for? Give folks a chance to answer the question. You can answer it in the question panel. Okay, so this question is, why do FX traders care about the equity markets? I'm going to give you guys a few seconds to answer this. Okay, I'm going to answer it for you. I can't see any answers coming in. Okay, the reason FX traders care about the equity markets is this: because the equity market shows us risk appetite. The way it works is the equity investors are very, very sensitive to risk. And if you think about it, the indices for the US, the UK, for Asia are just reflecting, how that country is doing as a whole. Okay, so when investors are feeling nervous, they think that there's going to be risk ahead, then they rotate their money out of equities. So equities start to fall. So when we see a falling equity market, that gives us a really good indication what risk is doing. So when we have a falling equity market, we know that risk is off. When we have a rising equity market, we know that risk appetite is on. Yeah, that's right, Ifan. That's exactly well put. Ifan's put, it's used to determine risk on or risk off mood because of intermarket correlation. Exactly. So this is what happens. Equity investors, when they're nervous, they take their money out of equities, and a lot of that money goes into bonds, which is why you see bond prices rise, which means bond yields are falling. Okay, so start to understand that. Start to think when I come to my desk, FX, pro FX traders, the first thing they're looking at is what's happening with the equity markets. It's my very first question when I come to my desk is, okay, what's happened in the overnight Asian equity market? What kind of risk mood are we in? Okay, so that's why we do that. And when you guys are getting your hand on the market, you want to do that as well. Just think to yourself, what is the equity market showing us today? You can take a screenshot of this. Falling equity market is risk off, rising equity market is risk on, right? So that's it. Great, well done, Ifam. That's spot on. So the main event in the Asian session was the Reserve Bank of Australia's Deputy Speaker de Bell. Okay, and the Deputy Speaker, Governor de Bell, says that the Australian dollar has come down and may decline further, adding that falls in the Australian dollar would be helpful and that the RBA would have to consider other options if rates decline to 0.5%. Okay, however, he does hope that the RBA will never get down to those levels. So Deputy Governor de Bell was quite bearish in his comments last night. Okay, obviously looking, wanting further falls in Australia dollar, and would have to consider other options if rates decline to 0.5%. So painting quite a bearish picture, right? So the current market pricing for the Australian dollar is as follows. There's 68% chance of a 25 basis point cut by the RBA by October, okay? So that means that by November, there's a 100% chance of a rate cut, and there's a second cut priced in for the RBA by April 2020, taking the rate to 0.50%. So that is the expectations. The expectations is to get down by 2020 all the way down to 0.5%. So that is what, the current market expectations are. Now, the reason we want to know what the market expectations are is because this gives us an element of understanding to how much the Australian dollar is falling, okay? Because we know that there's a chance of 100% chance of a rate cut by November. So what that means is, say the RBA's governor Lowe comes out this week and suddenly says, oh, the economy has improved, GDP is much better than we thought, inflation is ticking up, labor data is superb. We don't think we're going to cut we don't think we need to cut rates anymore. Okay, so if the Governor's Bank of Australia said that, what would we expect the Australian dollar to do? We'd expect the Australian dollar to immediately rally. We'd expect immediate dollar strength, and the reason we expect immediate dollar strength is because of the context that we're in now, that the market is expecting a 25 basis point cut by October and a 100% chance of a cut by November, okay? So it's all about understanding that the market context. So when you zone in on the market context, you then get to see the change in the narrative, and that's what you're trying to do, okay? But for now, we get market information. So market information as a retail trader is a challenge, okay? So the type of places you want to look at for information are places like Bloomberg, look at Reuters' website. Some of you guys know I work for forexlive.com, and they've got some excellent information there. If you follow that website, you will get lots and lots of information. So let me just give you that here, forexlive.com. Well, I've just sent that, guys, to you all. Etham, I've just sent that to you and to the rest of the listeners. As you follow along with that website, you'll get excellent, excellent information and resources that's accessible to you, just with a slight delay. That's the only downside of forexlive.com, is there is a very, very slight delay, but that's only due to the fact that you've got analysts analyzing the main news feeds for you. Okay. So as we look at the Asian session as a whole, we're looking at it. What we're seeing is the weak currency of the Australian dollar, because there's a more dovish outlook than the RBA. Now the strong currency, now this is a tricky one today, but the strong currency that I've gone for in the end is the Japanese yen. And that's because the Japanese yen has been moved very, very strongly recently on the risk-off sentiment. And mainly the risk-off sentiment that came in on Friday. Now, if that risk sentiment carries on, which is, I think it's more likely to be a risk-off sentiment, I think an Australian dollar Japanese yen pair should find sellers. And let me just take you through my reasoning, and you'll see what I'm doing. What I'm looking for personally at the moment is I'm looking for a fresh driver for the Australian dollar Japanese yen currency pair. That's what I'm looking for. I'm looking for a reason to reinitiate some Australian dollar Japanese yen shorts. Now, I was short Australian dollar Japanese yen on Friday, and I closed my profits out before the weekend, and I'll just show you how and what I did. So this is the Australian dollar Japanese pair. I just took this because it's a good learning point for us. If you see on Friday, we saw that the Australian dollar Japanese yen fell on a risk-off tone. Now, the risk-off tone was President Trump suddenly announced that he was going to take retaliatory tariffs against China. China released a statement about 2 hours before the Jackson Hole Symposium, and in that statement they were, launching back their revenge for the tariffs that Trump had put on China. It was their way of hitting back, and it was timed very deliberately to be just before Fed Powell was speaking. So it was designed to be as disruptive as possible, in essence. And as we know, Donald Trump loves to tweet, and he probably is quite a fiery temperament. So in response to what China did, President Trump immediately hit back, okay? And he announced fresh tariffs on, China. So there was, heavy risk off came into the market, and I'll just show you. Hang on, let me just see there. Let me just show you that. I'll just show you on our Telegram channel. Where is it? There we go. Actually, I can get one. And on our Telegram channel, HYCM Telegram channel, I flagged up that risk sentiment as it was happening. Okay, so I put that on as it was actually happening on Friday. And so if you're a subscriber to the Telegram channel, you would have got that notification, and you would have seen that risk sentiment was changing, very, very quickly. Sorry, let me just see, where's my things? Sorry about this. I just lost my go-to webinar control panel. Oh, there it is. There it is. Okay. Just wanted to get that so I can see your guys' questions as they come in. Right. Okay. So I was flagging that up real time. Now, yes, here it is. I've actually done this already. So this is on the HYCM channel, and what you can see is this is the risk-off tone coming into the market. Okay. Now this is very strong risk-off tone. So I took 2 positions. I put one position, when I've just come back from lunch, and I just saw the breaking news. So I took one position down here, and I took a second position as it retraced up to this level here. So I was just saying, this is a key place to expect sellers on pullbacks. Very straightforward trade. Anything up here, you're going to get sold off heavily. Expecting stops above there. The kind of another thing with stop placement, the obvious place to put your stops is there. So sometimes you get liquidity hunts. So people really do hunt stop losses. It's for a specific reason that if you're wanting to drive a currency down, but you can't get the liquidity, you can't get the orders to do it, then what you need to do, if you're a big fund or searching for orders, you need to get rid of some orders. So one of the ways of doing it is just putting hunting stops. So expect stops above there. That would be the sensible place to place stops, so you miss out on any liquidity hunt just up there, and you're just above that secondary swing, which is a better place to put stops. Even up there would be probably even better, right? So that's what happened, and then I just put these are the trades that I put on. You see that first position there, the second position I placed on the retrace, and then I just played my shorts down to a key pivot point here, just above the 71 handle. So I wanted it just to go just above the handle, just above 71, and I made sort of 70, 80 points for each trade on that Australian dollar Japanese yen short. Very straightforward, very simple trade. It was just obvious because the risk sentiment was so bad. The Australian dollar Japanese yen pair is a great pair because the Australian dollar will be hit when things are bad for China. So anything bad for China is also bad for the Australian dollar. That's why currency traders trade the Australian dollar as a proxy for the Chinese yuan. So you're thinking, well, some really bad data has come out from China. Which currency is going to be impacted? Then it's the Australian dollar. About 30% of Australia's GDP comes from trade with China. What's bad for China? Bad for the Australian dollar. What's good for China is good for the Australian dollar. So we can see with all these tariffs and retaliations, we can see, okay, it's obviously an Australian dollar sell. Japanese yen is a safe haven currency. When investors are worried or concerned, they put their currency into the Japanese yen. So Australian dollar, Japanese yen is a very obvious, straightforward trade, and it was just straight down here. So I just played it down to the next pivot point here, okay? So I entered around this pivot point, and I just played it down to that secondary pivot point there. Okay, very straightforward, and I didn't want to hold over the weekend. There was Jackson Hole Symposium, there was risks of Donald Trump tweeting, and as it happened, he did tweet after the market was closed, and that amount of event risk was just too much for me to want to be experiencing. So as soon as it got down to my profit, I actually went to the gym, came back from the gym, all sweaty and happy that my take profit had been hit down at this pivot point here. You guys know that often we're looking at pivot points are great targets. They can be good entries and they can be good places to put your stops as well. Okay. So that was, and this is the standard pivot point that you find on the TradingView website. Okay, it's just a stat. Pivots, traditional auto. I just use an automatic adjustment for the different time frames. Okay, so that was a very straightforward trade. But the thing I want to show you, look how sensitive the Australian Japanese yen is to risk. Risk off. Then on Monday, all of a sudden, Donald Trump, he changed his tune. We're going to be much conciliatory. We're going to do a deal with China. China's been on the phone. They've been really optimistic. They're wanting to get a deal done as well. And then we've seen the Australian dollar, Japanese yen rise. So this is a clue. The market is telling us that it's very, very sensitive to risk. Now, yes, last week we looked at trading sentiment while it's fresh. Okay. And what we said, there's two opportunities to trade sentiment, right? There's the phase one, the initial drop, which is here. Here to here, arguably here to there is phase one, okay? That is the first phase of trading, okay? So you had all that opportunity to get short. Now, the second opportunity I've said is if you put a 50% Fibonacci retracement level. So let's just pull up a here we go. All right, I'm just going to pull up an Australian dollar Japanese yen. Right, let's just pull up an Australian dollar Japanese yen pair. All right, there we go. So here's a 15-minute chart, right? Okay. So the first opportunity to get short was this one here. Okay, you can see there. That's where I was looking to. That's where I entered my second positions and sold it down. All right. Now, when we were looking last week at trading fresh sentiment, we said the other chance to trade the sentiment is at the 50% retracement level. So price got to this 50 retracement level, and you might have thought, well, let's trade this back down to the lows. Okay, trade it back down to here, 70-20, something like that. Okay, but that wouldn't have been appropriate to do on Monday. And the reason is that the risk tone changed. And so you had these positive comments by Donald Trump. You had a much happier kind of risk tone. So we had the Australian dollar Japanese yen rising. So it would have been a mistake to have entered at the 50% retracement. The time, what you would have needed to enter on the 50% retracement is you would have needed this drop, and then it just to be left hanging in the markets that Trump was going to put extra tariffs on China. And if that was just to leave it at that, that's the kind of scenario where you would have traded the retracement and then traded back down to the lows. Okay, but you see, as soon as we had the risk on, now I was like on my bank holiday, so it was a holiday for me, and I kind of was just dropping in and just keeping my toe into what's happening. And I would have liked to have gone long on the Australian dollar Japanese yen as the risk tone improved. And so if I was at my desk, I would have been trading longs back up to the highs if I could have done, okay, because the risk had changed. So I would have changed my short bias, would have become a long bias. Now these are very short-term trades, okay? But this just goes to show you how sensitive the market is to risk at the moment. So that means the market's sensitive to risk. So look out for fresh risk drivers. So that's what I'm looking at now. I'm now looking for a fresh driver. Okay, so I've got my Australian dollar Japanese yen pair open on my terminal, and I'm waiting to see another tweet, something else from Donald Trump, something else from China, something to bring risk down. And I know that risk will fall down, and I'll be looking for the Australian Japanese yen to fall back down towards these recent lows here. Okay, so that is how you go about trading that sentiment when it's fresh. That's why I'm not currently short Australian dollar Japanese yen, although my bias is short. I'm looking for fresh sellers to come into the market. That's really what I want. So I hope that all makes sense to you guys. So the European session, continuation of Australian dollar Japanese yen outlook as midday Europe coming into the US session. I'm favoring that. I'm staying Australian dollar Japanese yen short bias, but waiting for a fresh driver. That's what I really want. In the European session, we also have Boris Johnson. He said he's looking for an alternative workaround to the Irish backstop. It's just being worth aware that the main problem with Britain's withdrawal from the European Union and Brexit is that Britain and Europe want something very different than the Northern Irish backstop problem. The EU wants there to be a guarantee that that the Northern Irish border and between Northern Ireland and Southern Ireland will remain open, okay, that there won't be a border placed between Northern Ireland and Southern Ireland. And the real wrangling that's going on is, what do we do about this Irish backstop? So Boris Johnson is looking for an alternative workaround. So a key thing to look for in the market for the pound is, has a solution been found to the Irish backstop? If the EU accepts a solution, then we're going to see the chances of a deal really rapidly progress. If there's no alternative to the Irish backstop, then both sides won't have it, because Europe insists that the Irish backstop border is there. The UK insists that it isn't there. So both of them are insisting something different about the Irish backstop. So until a solution can be found to this, then we have a serious problem. So that's just to be aware. And Boris Johnson, the new PM in the UK since, I think it was 24th of July, he came in to the UK, and he has been moving towards a no-deal Brexit. And that is currently the most likely outcome for the UK at the moment, is a no-deal Brexit. It's fast becoming that scenario. So just to be prepared for that scenario. And obviously a no-deal Brexit, once confirmed, would result in the pound selling off very heavily. So as we're getting closer to the deadline, October the 31st, there's potentially some, very large trades setting up for the pound. And, that's something we need to be looking for. And from the 5th of September, UK Parliament meets again. So as of next week, UK Parliament will be meeting again, and we'll start to see some probably more volatility with the pound intraday. Now, we also had a tweet by Anna Soubry to confirm that there's been an excellent meeting between all opposition party leaders this morning. We agree will work together to stop a no-deal Brexit by legislation. So there's a race on now in the UK. Is Boris Johnson wants to bring Britain out of the European Union with or without a deal, and other members of Parliament, including the leaders of the opposition, want to stop Boris Johnson forcing a no-deal Brexit on Britain. So there is a wrestle within the UK Parliament. So that's a story to keep on top of, so that you realise what's happening and when. Europe mid-morning session had the European equities. You had the Dow, sorry, not the European. You had the FTSE down marginally, Euro Stoxx flat, French flat, DAX up marginally, and marginally up for the Portuguese, Spanish, and Italian indices. They were marginally up. So not much to report there. This kind of 50-50, very sensitive to risk mood, nothing strong. Yields were down though, indicating that risk is still there in the market with all these bond yields down, US yields down. That's quite concerning around risk. So it was more tilted towards a risk-off scenario. Sentiment for the US session, again, waiting for a fresh driver for the Australian dollar, Japanese yen, and waiting for a fresh driver for the pound. Johnson and Juncker, EU, so EU's Juncker, UK's Johnson, are due to talk this afternoon. So there'll undoubtedly be some headlines about their conversation and how it goes. And obviously, anything that's positive towards a deal will result in pound strength, and things negative towards a deal, I would say would relate in pound weakness. It'll depend on what it is, and also depend on how viable it is for the opposition government to stop Boris Johnson's no-deal Brexit. So that's one to keep an eye on anyway. Other major news is Italy's five-star government may be forming a coalition with the Democratic Party in order to avoid a fresh election. This has been a story that's been constantly bumbling away for the euro for weeks, really. It's not particularly moving the market, but it's something to be aware of. Okay, something particularly for euro traders, be aware of that situation. So we've done our looking back. Okay, so we now understand the context that we're in. We've identified one currency pair that we want to focus on, and we can see that that the trigger for that currency pair short sellers will be triggered by a deterioration in risk sentiment. So we kind of got our our scenario. We're also aware of a few other scenarios that may be moving in the market as well. So that's what we're trying to do by looking back. We're trying to find that that key story that's really driving the market at the moment, and where we're going to find the most opportunity. Looking forward for the week, we have US consumer confidence coming up. So it's worth just spending a moment to have a look what's happening with the US dollar. There's quite a lot of US dollar data out this week. Nothing much else apart from the US consumer confidence. What we have is the US dollar at the moment is being driven by expectations of the Fed taking a hawkish rate cut at their next meeting in September. Now, in their last set of minutes, the Federal Reserve iterated they did not want to be seen as being on a preset course, and that the minutes left open the option of a coming hawkish rate cut. Okay, so that's really what the market's expecting, a rate cut, but a hawkish rate cut. So in light of this, I'm expecting the focus to be on US data and Fed speakers for the coming week. Okay, good data and positive Fed speak is likely to find US dollar buyers on dips. With any positive news, traders will look to pair buying the US dollar against a weaker currency. So for example, one pair that is interesting at the moment is the US dollar Canadian dollar pair. Let's just pull that up. I'll just pull that across. So let's look at right, let's look at this pair. Right, okay, so we'll go to we can see that US dollar Canadian dollar pair has just pulled away from that 1.3300 handle. Okay, now we know whenever we're trading US dollar Canadian dollar, we need to be aware of oil, because there's like a 96% inverse correlation between the two. So oil at the moment is plus 0.75%. So there's some strength in oil, which means we like to see pressure on the US dollar Canadian dollar pair to the downside. But having said that, if we get a run of positive US data, and we've got the Canadian rate meeting coming up, the pressure on the Canadian Bank of Canada is to turn dovish. They're the only major central bank that hasn't turned explicitly dovish. The market's just waiting for them to turn dovish, right? So the kind of bias towards US dollar Canadian dollar pair could potentially be strongly to the upside, but we need a good run of US data, and we need a dovish twist from the Bank of Canada, and then we should expect to see US dollar Canadian dollar break out that 1.3350 level. Okay, so that's just a pair just to be aware of. Okay, particularly in trading the US dollar. So just one to look forward to. You'll see that through this week there's a lot of US data in focus. See, on Wednesday, and we have Thursday rather, we have GDP. That's going to be the most important release for the US this week, the GDP Q2 preliminary GDP out on Thursday, August the 29th. So that's something to really look for. Wednesday, not much there in terms of data releases apart from oil inventories for any crude traders. On Thursday, we have ANZ business confidence. Now, I find this particularly interesting, this New Zealand data point. Okay, the RBNZ, they are basically on a, they're on an easing bias. They're more likely to ease than the thing. They've kind of cut interest rates by half a percentage point, 0.5 basis points, 50 basis points. And since then, they're sort of saying we're in a wait and see mode. Now, business confidence is a very key input for the RBNZ. They factor business confidence into their projections, okay? So if we get a weaker business confidence data, then I would be expecting to see some more New Zealand dollar weakness. Now, at the same time, we've got Australian dollar data coming out for Australia, okay? Now, if we start to see some decent run of Australian data, we've had Governor Deputy DeBell speaking, but say we get some good construction work data on Wednesday, get good private capital expenditure data, and then we get a weak ANZ business confidence data, then we're going to start to look at a bias for Australian dollar, New Zealand dollar buyers. Okay, look at I have been long Australian dollar, New Zealand dollar. Okay, and I was long from around these levels, and I've taken profit up here recently. Okay, now you can see price is trying to break out of these highs here. Okay, so what we're looking for is any further downside. Okay, if we get a drop in business confidence, but we get a pickup for Australian data, then we're going to see further Australian dollar, New Zealand dollar strength. Okay, so you can see up to the 1.0700 level, just beneath it, 1.0688. That looks like a decent target should that happen. Okay, but we would need the data to move in line with that. So they're the things to look out for. Is look for a real drop in business confidence and a pickup in other Australian data. Okay, and then you potentially have a strong weak currency bias. And if you miss the original move, you can look to buy on pullbacks. That's where you'd expect rather to find buyers on pullbacks in that kind of scenario. Again, this is not trading advice. This is just showing you what I'm looking for and telling you what I'm expecting to see. And obviously things can change because you can have new data that's released. A governor can say something and it changes the outlook. But that's the general consensus that I'm looking for. We got some CPI data out for Germany that's coming out on Thursday. We've also got I've got it for Canadian dollar. Obviously, a whole swathe of US dollar data, but they're the main ones really for Thursday. Friday, we got some more Australian dollar data, building approvals, and we got CAD data. Okay, so that's one to watch. If there's a real dip in the Canadian dollar GDP data, remember the market is wanting an excuse to sell Canadian dollar. So any downtick in the GDP, say you get minus 0.1%, minus 0.2%, then that's likely to see a sudden influx of CAD sellers. So that's one to be aware of, but also where there's US data coming out at the same time. So just to be aware that if anyone was trading US dollar Canadian dollar pair, that you've got US data Canadian dollar released at the same time. Okay. But that's just, yeah, so that's kind of a little look ahead. Obviously, don't forget the manufacturing PMI data. Now, this is expected to be 49.7. It was 49.7 before. Services is 53.6 versus 53.7 before. So again, remember, you know, the market has been concerned about a slowdown in global growth really coming out of China. And if we get, you know, more slowdown in manufacturing, like so say that figures like, you know, 46, 45, you know, 47, the market's going to get, you know, be concerned about that, and you expect to see some risk off sentiment entering the market. So that's just something to be aware of. And obviously that's released over the weekend. So again, I think there's quite a lot of event risk. It's probably worth saying. I think there's quite a lot of event risk at the moment over the weekends. So I'd be very cautious about holding, you know, any positions into the weekends at the moment, given how sensitive risk is. Okay. Let's see, that's what we did last time. Here's some free resources to work out sentiment by yourself. These resources here, you can just take a look at that. EFAM, I'll see if I can copy that and send that to you. I'll try and send that. Yeah, there is a list of resources I've just sent out to you. So I'll just screenshot that. Well, that's come to you there, so you can follow along with the news. Again, Forex Live is good. FX Street is good. You really want to get a session wrap. So I'll show you, what to use. So if you go, so here's Forex Live, okay. And if you go to the session wrap, see the trading session wraps here. So just click on trading session wraps. And then this is a summary of what's been happening in each session. So look, this is the Asia FX wrap. Okay, so click on that and Ayman. Okay, and Ayman tells you, what's been happening. He often will highlight the key data points. You can see there. These are some of the Governor DeBell's comments he's been saying, and you can start to find out the major events in those FX wraps. So that's just one way you can do that. So I hope that's helpful for you. Yeah, dollar yen, Rosemary Shaw. Let's have a little look at dollar yen. So the first thing to notice about dollar yen, is that it's sensitive to risk, okay? Because so I'm responsive here. There we go. Let's see. Okay. The first thing to notice about the US dollar Japanese yen pair is it's very, very sensitive to risk. Okay. And the sensitivities to risk are because it's paired with the yen. So you can see that this was the reaction on Friday when risk off tone entered the market. You can see that massive drop suddenly there, and then the recovery. So at the moment, the US dollar Japanese yen pair is being moved around on risk. Okay. So if Donald Trump suddenly comes up and says some extra tariffs on China, expect the US dollar Japanese yen pair to fall. Now the other thing to remember about the dollar yen pair is that the Bank of Japan don't want the dollar yen to get too strong. So once the dollar yen gets below 105, the Bank of Japan, they're going to start to get concerned about the strength of the yen, and they'll start talking about, quantitative easing. Okay. Now, when a country talks about quantitative easing, it weakens the currency. So they want to protect their exporters because a high yen is very difficult for Japanese exporters. And you think Japan exports a lot across the world. So they're trying to keep this level from getting too low on the US dollar Japanese yen pair. Okay, they don't want the Japanese yen getting so strong. So the thing I'm thinking about the Japanese yen is two things. One, risk off, risk on. Very sensitive, moves a lot to risk on, risk off on. Two, once it gets below 105, you expect to see Bank of Japan's, central bankers speaking about their concern about a strong yen. Okay, so anything below 105, you're going to get central bankers getting nervous. So that's what I'm thinking about with Rosemary. I'm thinking about risk off, risk on, and I'm thinking about the Bank of Japan getting too concerned about strong yen at 105. The US dollar side of the pair, obviously, if you get strong US data, then we're going to expect to see this pair appreciate, but then it can sell off because it's paired with the Japanese yen. Okay, so it may not be the best. I don't really want to be short yen at the moment, Rosemary, because it's only one tweet out from Donald Trump, and you can fool. Look, this is 106. What's 106? We're 106.71 down to that's nearly 200 points down. Just because Donald Trump and China have had their recent spat on the trade war. So I'd be very reluctant to be short the yen at the moment. I hope that helps, Rosemary. Hope that helps. Let's now, quick things. Summary of the intermarket correlation. This is to help you understand intermarket correlation there. Just take a screenshot of that. Helps you recognize risk on and risk off. You can see high yielding risk on markets. When you've got a risk on market, what you see is okay, good, thanks, Rosemary. And when you see risk on markets, what you see is high yielding currencies like Australian dollar, New Zealand dollar, and Canadian dollar appreciate. The yen and the Swiss franc are sold off. So this is on risk on, okay? And that's what we saw when we were looking earlier. When we saw a risk on market, what do we expect? Australian dollar appreciate, Japanese yen depreciate. That's when we saw the Australian dollar, Japanese yen rising on Monday. But then going back to risk off market, then we expect yen and Swiss franc to appreciate, and we're looking for the Australian dollar, New Zealand dollar, and Canadian dollar to depreciate, right? So looking at the charts, we looked briefly at the Australian dollar Japanese yen pair. We saw we're looking for a fresh driver for that. So there isn't anything particularly technical to look at. Looking at your risk, always remember your risk management must be very, very good. You want to, I advocate, trading without using leverage. So these are the parameters that I recommend traders, especially beginning traders, trade with. Let your lot size match your account size. That's the general rule of thumb. And it may surprise you that as a professional FX trader, I trade mostly without leverage, and I only rarely use leverage. So I usually allow my account size and my position size to match. And sometimes I trade with less than full leverage. Don't forget the offers that are available here at HYCM, that when you deposit these specific amounts to your trading account, you will get these following benefits. So if you deposit $1,500 to your trading account, you get 1 hour coaching session with me. $3,000, you get 2 hours with me, 1 hour and 1 hour follow-up. $10,000, you get 2 hour session, 1 hour follow-up, and 1 week's VIP support from me. Obviously, don't forget you get these webinars for free as well on Monday and Tuesday, which again are helpful. But these offers are there as well, so don't forget that they're there. Now we want to quickly cover looking ahead, using the FX calendar to look ahead. Now here we go. So here's a calendar that you can use. I'm just going to put that through to you here. Okay, so this is a calendar that you guys can use. Now, what you're looking at is you're looking, when you're looking at, if you see here, okay, you've got the previous data point, the forecast data point, and the actual data point. So each Friday around sort of 5 o'clock, what you'll get is you will get the forecasts for the coming week released. Okay, so we can see, look, these are the forecasts here. Okay, these are all the forecasts for all these data points here, all right? Okay, you can see also private capital expenditure, 0.4%. So, for example, let's say we had the New Zealand dollar, let's say we had New Zealand business confidence. Let's say for the sake of argument, it was due to come in very low, minus 39. Okay, we think, oh, okay, we know that's bad for the New Zealand dollar, all right? And we've got the Australian dollar private capital expenditure that's due to come in at 0.4%. Okay, well, that's a lot better than last week's reading. Okay, so we're seeing, you know, potentially a stronger reading. So you think, okay, so going into this event, and say you had Australian dollar new home sales, building approvals. Okay, look, you've got building approvals up as well, private sector credit up a little bit. So you put that together, and what you're seeing is, okay, New Zealand dollar trade balance was down, expected to be down. So what you're seeing is there's a potential bias for Australian dollar, New Zealand dollar longs into these data points, okay? So what you're typically expecting is you're expecting, in this scenario, Australian dollar, New Zealand dollar buyers. Now, obviously, we had the negative comments from DeBell out on Tuesday. So that's, you know, that's not the best example. Now we've got the negative comments, but we still see these, you know, positive readings expected. So looking at that, we can see that we're expecting buyers on the Australian dollar, New Zealand dollar pair into these events, okay? So into Thursday, we can reasonably expect Australian dollar, New Zealand dollar buyers, okay? That is kind of the expectations that you're looking at. So that's just one way of using the calendar. You look what's, you know, and what you want to find a scenario. So let's look at the Canadian one. Here's GDP is 0.1%. Now, say, for example, we know the Bank of Canada is neutral, but we know the market wants it to be kind of bearish. Okay, so say we got this GDP was expected to be minus 0.7%. I'd be like, okay, well, we know the CAD's going to be sold into Friday, okay, because the expectations are for a very weak reading. We're expecting the Bank of Canada to turn dovish. So what you're looking at the expectations for the forecast in line with the current market sentiment. And when you look at the calendar, you can try to find some potential opportunities to trade a certain way in advance of the meeting. So ideally, with this Australian dollar, New Zealand dollar scenario, what you looked at is you looked at on Monday morning, you looked at opening Australian dollar, New Zealand dollar long. Okay, now obviously not trading advice, and this is after the event, but potentially that would have been a trade for this week, the Australian dollar, New Zealand dollar long. Now it's getting late in the day now because we're on Tuesday, it's Wednesday tomorrow, and it's just one day on Thursday. So you know that trade is too late for now. But you're looking to take a start as early as you can on the start of the week, seeing the expectations are different for the different currency pairs. Okay, that is the general way of using calendar expectations to look at potential trades for the future. Obviously, you've got to be aware of general risk things. So yen, Swiss franc, you know, you don't really want to be short the yen or Swiss franc because they can turn risk off any minute. And in the current market sentiment, that's very likely because we've only got to have one tweet from Donald Trump and then we're right back to square one. That's you know, a rough look at that, and hopefully, you know, we can start looking at that. I'll try to remember. If you guys remind me, we could look at the calendar as well for, you know, future events. So just put it in the questions, say, you know, anything in the calendar, and we can look through the calendar in the future weeks, so we can try and see some better examples of potential trades. Okay, everybody, that's the end of our hour together. Apologies once again for those who turned up on Monday, but I wasn't here. But I am due to be back here next Monday when we have our usual FX week ahead. I hope you guys have a really good week. Thank you very much for attending, and I look forward to speaking to you soon. Yeah, thanks, Aaron. It's have a look at it, and you can start to see what the expectations are ahead of the event. Remind me about it again next week, Aaron, and we'll look at it again. We'll keep looking at a few of them. Okay, guys. Yes, Rosemary, you do. You'll need to contact support. My purpose is on the trading, so I focus on trading and analyzing the markets. So just contact support, and we'll arrange a time to do that hour together, Rosemary. It'll be super. Look forward to it. Look forward to meeting you as it were in person. Lovely. Okay, guys, thank you very much. You all have a really good week, and I look forward to seeing you soon. Cheers, Van, Sammy, Rosemary, Sheik, Ifam, Aaron. Take care, guys. Thank you now. Bye.